time frames becomes less accurate. All right? As in any strategy or any price action signal, the smaller time frame will not allow you to achieve the same results as trading on the higher time frames. All right, so let's get started. All right, let's go over to our chart, and we're going to go through this right here. This is the perfect entry strategy. This is how you will learn to enter the market based on these three conditions. The first two are super critical. All right. Trading the Forex market, you will only be trading the market, or you're taught to trade the market at only support and resistance levels. That's it. We do not want to catch the market in the middle of the move. We want to catch the market at the beginning of a move, meaning the market has just touched down at support or resistance, and we're waiting for the price action signal, which is our confirmation to get in. The third condition, which if you notice is not red but yellow, it is not critical. In fact, you can simply place trades off of the first two conditions only, and the third one will always fall into place. Now remember, always is subject to criticism. All right? No strategies are 100%. So it's critical that when you're trading on this strategy, as in any strategy, you make sure that your entry is precise. All right? The reason why we do not trade after the moving average crossover is that usually once the moving averages crosses, once they cross, you will notice that the move is usually halfway over, or you're getting in 3 to 4 sessions, let's say 2 to 4 sessions late, and that can mean half of your profit. So the first condition is always the market being at support or resistance. Most of you, if not all of you, should know how to plot on your support and resistance lines. For those of you that do not know, you plot your support and resistance lines on your higher time frames. The daily chart will give you a mixed bag of, you're going to have great levels. You're going to have a nice number of great levels of support and resistance lines on your chart when using the daily chart. If you use the monthly chart or the weekly chart, you will have great levels, but not as many. If you use the minute chart, 5-minute and all the smaller ones, you're going to have thousands of different levels, and not all of them will be strong. So that will mean you'll have the likelihood of more fake outs. All right? That's why I say you can trade this strategy on any pair, any pair as well as any time frame, but the higher time frames will be the most powerful, especially your 4-hour and definitely your daily. All right? So let's plot on some our support and resistance lines. Once we're done, our support and resistance lines will ultimately look like this based on this chart. This is the same chart. And all of these levels, if you notice, they're all of different shades, different colors. When you back test them, they're all great levels, at least in the immediate price action. What you can see in the immediate once you pull your chart all the way back. We don't necessarily worry about what's up here because the market will have to get to your highest level first before you even think about plotting these on. It will be an overkill. Just to let you guys know, you do not need to have all of these levels on. This is just for educational purposes. Nor do you have to have different colors. When you plot your levels on, it's usually in the most immediate price action areas. So you will not have all these different levels and all these different colors. Once again, let's go back to our original. Let's go back. Now, we plot our levels on. We'll always start with the top or the bottom. Draw a line. Alright, in this case, draw a line there. I look left and I notice that these levels are being hit a number of times. Alright, that's a good level. I'm going to go with this low because I know that this was an all-time low at some point. Now this is the low of the low. Alright, what I'm going to do, change the color. Lock that down, look left. Well, we know that this was the only time it hit back in 2013 and then again a few months ago. Alright, and now we have this level down here. Change that color. We'll make this one white. And we know this is obviously the lowest, so we know that it never hit this level before. So now we just fill in a blank. We fill in between. The market came down, touched there, change this color, change it to aqua. We look left. Let's lock that down first. Look left. See the market tapped here, tapped all up in there. That's it. And that was going back 6 years ago, 7 years ago. Alright, so that's a good level. Put one here because after it hit here, it went up to here and turned around. Change the color of this. Make this yellow. Look left. As it broke down through this level, came down to here, bounced up, came back down, hesitated for a second, then it dropped. And that's the only time it hit that level, besides here. From there, drew another level, it dropped through, rested its footing there, as well as it came up, came back down to this level, slowed down, came down, came back up, came down, came back up to the level, broke up, came back down, broke through it. Let's look left, not before changing the color though. As you see, the market bounced all up in here. So this is what I would do for the entire chart, just like this. Just go, put your lines in, put your support and resistance levels in, and then I will be good to go. All right, let's move forward to our now. This right here is basically our moving averages with our support and resistance lines on. This is the 7, this is the 14. These are our directional moving averages as indicated here. Alright, so when the market reaches your support and resistance, the next thing you're looking for is price action, a confirmation signal, and then once you get into the market, that's when you will be waiting for a confirmation, another confirmation, which would be your moving average. But you're already in the market on here. You're not waiting for this to get in. This will get you in. Condition number 2 will get you in. This would just be a confirmation. What I mean by that is this. Here, the market reached this level of resistance. Okay? And what had happened was, at this level, the market slowed down. Alright? Broke through, pierced through, broke back down, 2 very small volume days, and then you had an engulfing candle at resistance. The way you do this is, I teach not to get in during the actual candle that's giving you the signal. Price action is nothing more than a closed candle indicating where the next move is going to go, where the current open candle will move to. Alright, so if this candle was open, you do not want to believe that the market is going to go down, because if the candle is open, it could very well turn around and go up. And if you do not believe me, just look at your chart. Look at here. If you saw this candle, originally it was down here and it was bearish. But look what happened by the end of the day. It turned bullish, and then it gapped up, went sideways, and went up more. Now, if you had enough strength in your account, you could have held out, but it wouldn't get you again, and then eventually you would have been in a profit. But you want to make sure that when you receive your second confirmation, your second condition, you want to make sure that your condition is complete. And what makes a complete price action confirmation signal? The closed candle. So here, going back to here, if this candle was still open and moving, you don't have the signal yet. You have an impending signal, but it's not complete. It's better to wait for this candle to close and get in during this session and ride the market down. Then it will be to get in here and the market is moving about, taking you in the money, out the money, and then you're stressed out. Let the market close. Then you get in. And that will be on this session. This session you get in. And what I do, I only get into the market on the London and New York session. Sydney, Tokyo, I don't do it. If I saw this candle close and it's giving me a great signal to get in, because of my discipline, I choose not to get into the market until the London and or New York. Because it's oftentimes the market will go in one direction on the Tokyo or Sydney, and by the time the London and New York, it'll turn around and it'll go in the opposite direction, which is more than likely what happened here. So I'll wait until the London or New York to get in. That way, if I open up my charts and it's showing bearish, I'm getting in because this signal told me so. I can get in with full confidence that it's going to go down, and I run the market down until it reaches a support or resistance. You will only be getting in when the market has reached the level of resistance or support. We do not wait for the market. We do not get into the market in the middle of a move. Only when the market has reached our level of support and resistance will we get in. And it's not when it reaches that level. It's when it reaches the level and we receive a confirmation candle, which would give us 2/3 of our perfect entry strategy have been filled. 2/3 filled, we're comfortable to get in. And what I mean by that is the market was at this level. Check for the condition number 1. Did you receive a confirmation price action signal? Check. Engulfing candle. So if you got in here at some point you'd have been good to go. Profit wise, you could have made 1,400 pips. Now, if you had waited until the crossover, you may have gotten in here a day late, a day or two late. And that's what happens. For instance, if you got the market here at support, you had the market is at support, check for number one. Did you receive a price action signal? Yes, check. You have the confirmation candle here, engulfing candle, so you got in here. You could have ran the market up to here for 1,000 pips. At that point, you're good to go. But you're getting in here. The crossover didn't take place until here. One of these two candles. So you could have wasted 1, 2, 3, 4, 5. 4 or 5 days before you had gotten in. Alright, so if the first two are met, more than likely the third one will always take place. Alright, unless the market is just acting funky and it's just, just snaking like this. Oftentimes it'll just act funky. But still, if you're waiting for the market to be at support, confirmation you're getting in here, you're still getting in days ahead of the cross. Market is at resistance. Got the signal here, you're getting in here, you're ahead of the cross. Very simple. Oftentimes you might not receive a clear signal, but you have enough leading confluences or leading, you have enough logic to tell you that the market is going in one direction. Usually it's because the market has been at a level of resistance or support, as in this one, for a while, and you know it's not going to break it. If a wall is constantly being punched with the same force, it's not going to break it. If it's keep bouncing and bouncing and bouncing off, it's not going to break it. Chances are you're going to need more force. So what do you think is going to happen? You're going to need the market to go all the way up, and remember this orange line here. You're going to need the market to go all the way up and then come down and power its way through. This was the Brexit. The market powered its way through this level and also gapped. Look where the market is now. Very simple. So just remember that the moving average is not critical. Nothing like the first two conditions. All right. Now, if you know price action, that will definitely help you. Golfing candles, hanging man, there are so many different price action signals that could tell you where the market is going. I assume at this point you know price action. Something that's very important to note about these pairs, about this perfect entry strategy, is that this strategy will, while most will trade because the market is open, you will wait for a setup. You're waiting for the perfect setup before you get in. So therefore, it will greatly decrease the amount of fake outs you're in on. Greatly. So now let's take a look at, let's closely examine our let's see. Let's closely examine these. These are our moving averages. All right. And actually what we're going to do, we're going to look at these for right now. And then we're going to go into the other ones. For those of you that do not know, the yellow and the red, which is 7 and 14, whenever the yellow is crossed below the red, the market will go down. Wherever you look at it on the chart. Yellow below the red, it will go down. Now, wherever the yellow is crossed above the red, it will go up. Alright? Wherever, it will go up. Very simple. Keep that in mind, because that will help you. Now, when we draw on our other two moving averages, and something to note about the yellow and the red is the yellow and the red are our directional moving averages. They are very sensitive to price action. Let me show you what I mean. If you when this candle that's open, when it moves, watch the yellow. It will flicker. Now the market is moving slow right now, but give it time. Once it starts to pull down, you will notice that it's going to flicker. You can look at any chart and see that. We are on the GBP. Let's go with actually, let's go back. But basically, I want you guys to pay attention to the yellow and the red. The yellow and the red are your directional moving averages. Wherever your price action, meaning the candles go, all right, they're pulling the moving averages behind. The moving averages are very accurate in a sense of telling you the direction it's headed. Although, and I note this and I want you guys to remember, they lag. That's why the crossover happens when it does. It's late. But if you know price action, and if you use the moving averages to help you realize where the market is going, along with support and resistance, you cannot lose unless you become greedy and impatient, stay in a market too long, or just any of that. So let me show you what the green and the purple, the significance of the green and the purple. If you notice, the green and the purple, let's go back to the minute chart. Let's just examine the minute chart for a second. If you notice, the market runs to the moving averages and backs off. Came down to the moving average and came back up. You know, you'll notice these things. Came down to the purple. Came down to the purple. Came down to the purple. Came back up. Purple. Green, but it broke through. Came up to the red. Came down. Came up to the red again. Came down. Alright, came to the green. Came to the green. Came down to the green and the red. Down to the green. Down to the green. So when you're trading on the market, green, purple, all of them, purple, you start to notice how the market is using the moving averages for what? As support and resistance. That's the reason why you use moving averages. You do not need all the other fancy indicators. You don't need all that. In fact, you don't even need Fibonacci levels for telling you the likelihood of where the market's going to turn around. I don't even use Fibonacci. I hate Fibonacci. I actually use my own support and resistance. That's all Fibonacci levels are. They're support and resistance. So, with that, when you start to notice how the moving averages are being bounced off of, you start to respect the moving average. When you see the market going, for instance, if you take the chart up to here, and let's take a look at this. So I told you how the market will watch the yellow. It might be slow right now, but it'll give it time. It'll flicker. See that? Now, mind you, this is the minute chart. So, because it's the minute chart, it's more sensitive to the moving averages. If you looked at the minute chart side by side with the daily chart, that little move right there would not have done anything to the, or let's say much of anything to the day candle, well, to the day moving average, the 7. But it does a lot to it on the minute chart. All right, so these two are your directional moving averages. As the market pulls down, guess what it's going to do? It's going to pull, if you can imagine this, it's going to pull the yellow underneath the red. Okay, you imagine that's the reason why you have this. You have this because what happened, it was up here, the market closed here, but the market opened here, and it yanked the market down. So pulled the yellow down. Then the market gapped up a little, and then it's been going upward. And that's why eventually it crossed above the red, and it's going like this. But now it's reached the level, and it's showing that it might not go up any further, but it's the minute chart, and it's so all over the place. That's why we don't focus on the minute chart. This is just an example to show you why I consider these two the directional moving averages. Now, when we go back to the daily chart, you'll see some of the same. The market going to the green. All right, you'll see how these moving averages are very powerful. The market came down, rested here, came up to where? The green, turned around, came up here. Like I said, if you were trading on a market and you just open up your chart this day, if you open up the chart on this day, you would have thought that the market was going up. If you open up your chart and the candle was up here and you do not trade price action correctly, you trade price action, you trade it when the candle was moving instead of the closed candle to give you a reason to get in the next day. If you do that, you'd have been faked out. You'd have been getting in here and the market pulled right around on you and it kept going down. You ignored the fact that it ran up to the purple, or if you got in here as it was going up and you didn't take your money up here, you ignored the fact that it came to the purple and turned around and it kept going down. And it never got back up to this level to give you your money back. It's nowhere close to it. That was all the way up here at the 225, 227. And the market is down at 207 right now. I'm sorry, 170 right now. So that's just a reminder of how powerful looking at price action can be for you. All right. So here we have the 7, we have the 14, we have the 33, and then we have the 60. All right. You should have received this template, it's the So Done Easy Forex Millionaire Combo Setup. You can install that a couple ways. All right, when you download it, and I'm sort of going backwards with this, but you should have received another video with how to upload the template. Very simple and easy. Once you download the template to your computer, let's say it's on your desktop, all you do, you go here, load template. It's going to open up another dialog window, and you search your computer for that template. That's all you do. Very simple. Search your computer for that template. Once it's in there, hit OK, it uploads. Very simple. Now, another way to do it would be coming here, going to Open Data folder, going to your templates folder, and then dragging it into here. All right. Now, if you if you look inside of here after you have loaded it, if it's not showing here, you need to restart your platform. All right. So remember, the yellow and the red are your directional moving averages. They will show you which way the market is going. How do you trade the yellow and the red? When you see this, all right, you look at the candle patterns. You see the market is pulling down. All right. You see this right here. It shows is that it looks like the market might go back up. So if the candles are pulling the yellow, the red, the purple, and the green in that direction upward, you could expect some of this to happen. For the market to cross out, the yellow and the red are crossing over the purple. If the market kept going over, they would have just flipped up and kept going that way, sort of like this. Everything was going down, and then the market went up, and the yellow, red, and the purple, and then it flipped over top of them, and now the market is going up. And then as the market went down, it flipped beneath them, and it tried to keep going upward, but it couldn't go, and it stayed below. Now, it did go above here, but then it quickly went back down. So now we're at this point, and it could go up, but we're waiting. So that's what you do. You wait and see what happens. But it could very well go down. So remember that the green and the purple are your support and resistance moving averages. That's the purpose that they serve, just for support and resistance. All right. If the market is going upward, if you got a candle and it's going up, if it's going up, you see it's going up, you should be looking to take your money at here, at the purple. When a market, because usually it'll come up there and it'll pull back. All right. When you see that, take your money at the purple. All right. Or if it cross there and it keep going, take your money at the green. All right. Now, this right here is more of the so darn easy Forex strategy. We're going to get into more of a long-term objective type trading. This right here is more of your trading today, staying in trades for a day or two. This strategy is perfect for that. All right. Now, remember that you will have your support and resistance lines plotted on your chart. All right, you will have them plotted on. And something that I want you guys to pay attention to is this. When you have your lines plotted on your chart, oftentimes, give me 1 second. Oftentimes you might have your lines plotted on your chart. You might notice the market touch down in support and it's starting to go up, and you see that where the market is headed, there's the moving average. And then you also have what? A resistance level there. Treat when you have both in the same area, treat them as a double layer of sheetrock. In order for it to break through, it has to be very strong to break through there, the momentum. So in your mind, think of it as it's going to be hard for it to break it. So I'm going to bet that it's probably not going to break it. It's going to bounce. All right. Whenever you have the market moving towards a support or resistance level, always expect the market to bounce. That's always. But let the market prove to you. Well, I'm sorry. I apologize. Let the market prove its direction, its next direction that it'll move in. So if the market is going upward, as it was doing here, and I'm watching the market go up, I know I have a resistance here. I know I have another resistance, which is the green, the 60-day moving average. I'm looking at this as a double layer resistance level. It's going to be harder for it to break it, so I'm going to expect it to bounce off of it. Even if it's one level, you still expect it to bounce off of it. If I saw this and I saw this and they were both the same setup, same exact setup, I would bet more money on this, the market not breaking this, than this. Because this one has two levels, two layers, and this one only has one. All right? Now, so this is the So Darn Easy Forex strategy. Some takeaways from this is make sure you remember that the yellow under the red, the market goes down. Yellow above the red, the market goes up. All right. Something else is that we remember our perfect entry strategy. This goes with any strategy. This goes well with any strategy. You always wait for the market to reach your support or resistance level for that condition to be checked off. You then wait on the price action signal at that level for it to be checked off. That's when you can get in. Because I am a London and New York session trader, if I am in on a trade and I take profit in the London or New York, let's say I take profit in the New York session, because it's giving me a signal that it's going to go in the other direction. Just because the signal painted that it's going in the other direction, I do not get in as soon as the next session opens. I'll wait until the next London session to realize if it's going to actually head in that direction, London or New York. At that point, that's when I would get in. So, let's see. I believe this is all that I will be showing you all on this one. This is the So Darn Easy Forex strategy. Now we're going to add we're going to add everything in. As you notice, we now have two new moving averages. This is your 200 and this is your 400. These are your powerful moving averages. Remember, you can trade these even. You can trade any of these. You can trade any of my strategies on the long term. I apologize, on the smaller time frames as well as the longer or the higher time frames. These two moving averages are very, very extremely powerful. If you notice, the market kept bouncing off of the blue. And eventually it bounced off the blue on above. Came up to the white, bounced off. Green came down. White came down, bounced off the green the whole way down, and the purple. Alright? Now, what I want you guys to pay attention to is this. Whenever, just like the yellow and the red, whenever you have the yellow cross below the red, the market goes down. And that's the same as whenever you have the white cross below the blue, the market goes down. Conversely, whenever you have the yellow cross above the red, the market will go up. Or like here. Which will be the same as whenever you have the white cross above the blue, the market will go up. Alright? Now, the one thing about this, doing this particular strategy, the long term, trading long term, is that you will need to develop a higher level of patience if you're trading this off of the daily chart. Now, so you might ask, okay, so what time frame should I be trading off of? Because you said the short term, the short time, or the smaller time frames are not that accurate. Yes, that's true. However, through my own back testing of every pair, I know what time frame you should be trading this on for the best accuracy. All right? That's the hour. The hourly. You can try the 4 hour, but the hourly works best. All right? Let me show you how this is done. Now, let's move this forward and let me show you. If you go back to April 2015, a year ago, that was down here. The market was ranging at this level for some time. April 2015 is here. This is where the market first started going up. And you'll notice on the daily, at this red line, then the market went up and went up again. Then you had a long wick. Then it went down in like 3 humps. Let's go to the daily. See that? Went up, came down in like 3 humps, came down. All right, so this is where the market was. And when I said it was ranging, it was ranging at this level, and then it finally hit the bottom, same level, and it went up. All right. Now, go back to the hourly. When you see, like I said again, when you see the white cross above the blue, the market will go up. It's in an uptrend. When you see the white cross below the blue, it will go down in a downtrend. Above, up, below, down. Be careful when it starts snaking like this, but you can make a little profit. It went down, snaked a little, it was still going down. When it went up, down. Look at this. Look how the market crossed below. Look how the white crossed below the blue. And look what the market does. Stopped at the green, stopped at the green and purple, came down, consolidated, came up, crossed above the white, came to the blue, didn't break it, came back down. See that? And then it's been ranging. So when you saw it hit down here, when you see us pulling up, one thing to note about these moving averages is that, and let's go back to the yellow and white. I'm sorry, I apologize, the yellow and the red. When you have the yellow and the red moving averages, when you see the market or you see the moving averages, if it's not pointing up really hard, if it's kind of like going sideways, it's giving you the idea that it wants to curl back down and go down. All right? At some point, the market was down here and it went up. went up to here, and that's why you have this curl. But then the market started to go down, so now it's this candle here is going to try to pull the market down. It's going to pull the market down if it goes down. So you see it's respecting the green, bouncing off the green. Although it pierced it, it can still bounce off the green. You see that. All right? But in your mind, you have to keep in mind that you have to realize that this market the moving averages will only move based on the price action candles. All right, and that's why the market went up like this and it went down. That's because look how the candles went. The candles are acting, and then the market, the moving averages are reacting. All right, so the market has to act first in order for the moving averages to respond. Okay, so that being said, when you start to really study the moving averages, you'll notice that when the market becomes exhausted, if the market shot up, like here, let's say it went up and it became exhausted. Once it becomes exhausted, when it starts going sideways, what do you think the moving averages are going to do? They're going to go sideways too, unless it pulls down really hard. Then it's going to, remember, the price action, these yellow and red are your directional moving averages, so they will pull the yellow and the red with it. Like here, if this candle here drops all the way down to here, this is going to have a crease in it, just like this. You can't see it, but just like this, because this candle had so much momentum and volume behind it, it yanked it down, causing it to crease, sort of like this. See, this market was moving down. Every hour is moving down. Then when it came here, it went sideways. The candles were going sideways. It never broke this level. And if you notice, this level is the same as pretty much this level. And then when you had this candle here, it had no other choice because the yellow is being pulled by the price action candles. Once it yanked up, it had to cause this crease right here. And then it sort of went up, and as you see, once it went sideways because that was the motion of the candles. And then it trickled its way down and it went sideways again, following the candles. All right? So when you translate that over to what I was showing you with the So Down Easy Forex Millionaire combo setup, when you're looking at the yellow, I apologize, when you're looking at these, and you see that these moving averages are doing nothing more than what price action is telling it to do, you will then realize that all you have to be is at the right place at the right time. All right? You have to be able to read everything that's going on, not just the white and the blue, but also the red and the yellow. You have to look at everything. You have to consider where's price at in comparison to, support and resistance. You have to look at, okay, how far was the market going upward? And is the market having a hard time breaking this level? Yes, it is. So if you know that the market only goes up and it goes down, then you would believe that at some point, because the market rallied over 5,000 pips from here all the way up to 246 level, you would know that the market will become exhausted. And once it becomes exhausted, just like two boxers boxing it out in the ring, one will become exhausted and get pushed against the ropes while the other one is punching away. Same thing, it will change hands. So if it couldn't break this level, you would expect okay, if I see that the market has been bouncing off the blue all this time, and if it's still at this level and it can't break it, if it's having a hard time breaking this level, it's running out of space, eventually the market is going to cross below the white and the blue, and then it's going to start going down. Because we know, as we know it, when the market the candles are above the white and the blue, it's in an uptrend. But when it's below the white and the blue, it's in a downtrend. Show you a little better here. It's in a downtrend when the market is below the 2 and the 400. When it's above it, it's in an uptrend. Okay? So now you ask yourself, how do I trade the yellow? How do I trade? I apologize. I always apologize because I don't like saying I'm sorry. But you ask yourself, how do you trade the 2 and 400? This is how. Now we know that whenever the white is crossed above the blue, it's going up. But whenever the white is crossed below, it's going down. All right? So this is how you do it. Whenever the market whenever the market is above the white and the blue, we know it's going up. But when it crosses inside, in between the white and the blue, that's telling you, that should give you a heads up. Hey, the market is weakening, going up. It's weakened. So now it's declining. That's why it's going between the white and the blue. So you wait to see if it crosses below all the way below the blue. All right? Just like if the market is here, the market, if you notice, the market was staying away from the white and the blue. It was bouncing off the green. But once it touched down here, it did a double tap. Touched, came up, touched again, low, then it started to go up. And you notice what? The white and the blue crossed above. So now let's reverse that. The market is up here. You notice the market is having a hard time cross the resistance. It crossed back below the white and the blue, went to the bottom of it. But remember, you notice the market was bouncing up and down, kept hitting the blue. So you could have been taking profit here, coming down, running down to here, coming up, taking it back down to here, coming up, taking it back down to here, and then so on. But you notice it kept hitting this level but not breaking it. So with that, once the market come back down to the blue, every time it comes to the blue, you watch it closely. Because if it breaks below the blue and keeps going, that's your way in. All right? But how do you know when it's going to do it? Because all these times it came down to the blue. Well, this is how you do it. Just like I told you about the yellow and the red, when the market has become exhausted, you're going to notice it's not pulling down hard anymore, as in here. You're going to notice that the yellow is starting to bend. If it's going down, it's going to go down. They're both going to be pointing down. But when it's slowing, it's going to reach a level of support or resistance, and then the yellow is going to start bending upward, just like this. Take that to the white and the blue. When the market stops going up, the white is going to start bending downward. Now, one thing to keep in mind is that, see the distance between here, the white and the blue? What do you think happened over here? It started to get real tight. Just like here, it was going down, it widened, then it got wide, then it started getting tight all around here. But around this area, what happened? It was starting to sort of range. All right, so once it started ranging, remember, the white and the blue, while they are very slow, they're very powerful. They will show you what's going on in the market. So, as a market crossed above, this is your reason to know, this was your signal that the market has weakened going down. Just like here. The market was going down, staying far away from the white. But then all of a sudden here, it touched down, came up, broke inside of it. That lets you know, okay, it's probably going to go up soon. Then it came back down, and this is what usually happens. It'll cross in, come back down, the same level, and then it'll go up. Here, it'll zoom in. At times you had a market come down, it'll come up, come back down, and then you have to watch it. You see how tight the white and the blue were? They were really tight up in here. So you know whenever the market crosses inside of the white and the blue, it reaches the blue, because it'll always cross past the white first, and then it'll touch the blue. It'll never be the other way around. See this? Even over here, it always crosses to the white first and then the blue, regardless of which direction it's on. So once it crosses to the white, that should be your reason to watch the charts closely. Because if it gives you a signal that it's going down, that's going to be your reason to get in. Now, this is how powerful this strategy is. All right? If you know that the white is crossed above the blue here, and you know it's showing signs that it's going to go down, crossing below the blue, you can literally get in a trade and hold that trade for months at a time. Let's say your signal was anywhere in here. You held this trade at 1700 pips. All right, 367 hours. We're on an hour chart. All right. Okay, the market, you start seeing the white and the blue tightening. You see the market touch down here, it came up to here. So it's telling you that, okay, all this time the market was going downward, making lower lows, but all of a sudden now it reached down to here, and that's why your levels of support and resistance are so important, because if this level was a good level, if you look back and see, see that? Very good level. Since this is a good level on your day chart, you see this? On your day chart, this is a good level. Go to your hourly. All right, since this is a good level, we expect, like I told you, you expect for the market to do what? Bounce. So we have a couple confirmations here. We got the market coming down, stand far away from the white, then all of a sudden it starts to get closer. So we have it touch down here, and then it goes up. Then it crosses above here. That's another sign. So that's the second confluence. All right. This is number one, support. This is number two, the market crossing in between the white and the blue. All right. Then you have the market come back down to here and then go back up, and look, the white starts to go sideways, and they are ready to cross. It got really tight. So that's your third signal. You should be ready to get in. So then you could take the market up. So if you had taken the market up, well, we're going to do the math on this, but let's just say you got in here. You know, that's a lot of pips. This was entered on 11/3/2015, and this was you're talking 2 weeks movement, 2.5 weeks of movement. Let's say 3 weeks, 700, 800 pips. Not bad. So, how would you get in? How would you get in? Let me show you. Like I told you, when the market comes down to the blue, you expect it to, well, not that. When the market comes down to the blue, you do expect it to bounce. That's for certain. You do expect it to bounce. Okay, but when the market comes down to the blue, because all the times it came down to the blue, you expect it to bounce up. And usually it will. Sometimes it'll cross below, but if you have your support and resistance plotted on in the immediate area, you'll know, okay, it might create new levels too, but you'll know, what to do. You'll pretty much know what to do because you're watching the movement, and you're letting the market show you and dictate which way it's going to go. Not you doing it, because you can't force the market to do anything. So when the market came down to the blue here, as it did in all these, we were waiting for a signal to keep going down. Did we ever receive a signal? No, the market went back up. Did we receive a signal here? No, the market went back up. Did we receive a signal here? No, it went back up to the white. So it bounced down to the blue, came back to the white. The white acted as resistance, just like the blue acted as support. Even though it broke below it, it's still in the same zone. So I treat it as blue. All right, except for this one. This one broke below it, but even still, even this one, it still acted as blue. So it broke here, came above, acted as resistance, came back to it, and look what happened. It stopped at the bottom. If you put a line here, that's in line with all of this. How sweet it is. And what did the market do? It went back up, tried to go above the white. Well, try to run to the white. It couldn't. It backed off. The next day, you had a confirmation sell signal right here. Below that, broke below this level that I just plotted on after it couldn't break here. And what happened? The market sold off. And it kept going. And this could have been your doorway into major profit. Major profit. What you do, what's most important, is to make sure you're reading the charts right. The day charts is fine, but you'll get in earlier on your hour chart. And do not, I warn you and I caution you, do not say, okay, well, if I can get in early on my hour chart, then I can get in much earlier on my 30-minute chart. I caution you. While it might work sometimes, you might get stopped out because you're not going to always catch it. So be careful. Even with the hour chart, be careful. I have tested this a number of times and I know that it works. So do not try to reinvent the wheel, because this is a very powerful way of doing it. All right? Now, that's pretty much what the long term is about. You get in and you ride the market down. If you were on your daily chart, and that's the reason why I am sell happy on the GBP/NZD. For those of you who have seen my trades, that's pretty much 6 figures. That's the reason why. Because this is all that I need to read which way the market is going. Just like I told you, the market was crossed above the white, crossed above the blue here. It went up. It reached this peak. And then it started to decline. And once you start to see this, the bending, you know, okay, more than likely it's going to go down. And what happened? It crossed below the white, came down towards the blue, came back up to the white, couldn't shake it, came back to the blue. It stopped. Couldn't do anything. Then it gapped down. It gapped down from the blue. It couldn't break through it. It gapped down from the blue. And then it used the same blue as what? Resistance. Came down, came back up, went to the white. I'm sorry, I apologize. Went to the blue again. Broke back down. And this is where it's at. And what happened? The white is crossed below the blue. Very powerful. All right? Now, I hope that you all were able to learn a lot from this training, because this training will change your life. It will change your life, but you have to adhere to the rules. You have to. The rules will set you free. All right? When you take in all of this knowledge and you combine it, you can use all of this to trade whenever you want. All right? You don't have to worry about anything else. Just use what you have here, and this is all that you ever need to trade the Forex market. This is it. You do not have to wrestle with it. This is all that you will ever need. As long as you can read the charts, as long as you can read the moving averages, because the moving averages, this is why I only use moving averages, because they are very, extremely powerful. Forget using all them indicators that everyone rant and rave about. Forget about them. They only screw you over. Forget about signals. You do not need them. If you are interested in learning a deeper level of trading on this. And what I mean by that is the money management, because I go into great detail about the money management aspect of trading, higher lots trading with a much larger account sizes. If you're interested in that, the long-term membership is available. I definitely appreciate you guys for purchasing this